Hey everyone, welcome back to The Explainer. Today we're diving into a high-energy, absolutely no-fluff masterclass designed to do one very specific thing: stop you from getting faked out by market movements. You know that pain point, you're staring at a chart right after the opening bell and you just feel totally lost. Or maybe you consistently find yourself on the wrong side of a massive price swing. Well, you're in the right place. Let's decode this market language from the source material so we can finally stop predicting and start profiting.
Okay, let's just get right into it. Here is our roadmap. First, the daily trading trap. Then, the change of character. Next up, fueling up with liquidity zones. Fourth, the double confirmation rule. And finally, your CoC execution checklist.
All right, starting off with Section 1, the daily trading trap.
Let's talk about that universal frustration day and swing traders know all too well. The market opens and boom, you're hit with an immediate high-stakes dilemma. Do I buy or do I sell? Without a reliable framework, you're basically flying blind. We end up reacting to every little twitch in price. And honestly, that hesitation, that's exactly what the market uses to separate traders from their money.
Let's validate this pain point for a second, because it is incredibly real. You're looking at a wildly bullish market that's been ripping upwards all morning, and buying in feels like you're way too late, like you're buying the absolute top, right? But on the flip side, looking at a deeply bearish market, shorting it feels incredibly risky, like you might be selling the exact bottom right before a massive bounce. We desperately need a structural framework to eliminate these emotional gut-feeling guesses.
Now, obviously, before we fix that, we just need to quickly establish the absolute basics of trend structure. An uptrend is simply continuous higher highs and higher lows. A downtrend is continuous lower highs and lower lows. We all know this, right? But while knowing the current trend is helpful, it won't actually give you the most explosive trading entries. To get those, you need to know how to spot the precise moment these structures break.
Which brings us to Section 2, the change of character.
The source material zeroes in on this as the core concept, the change of character, or CoC. It's that powerful turning point where a market just completely abandons its current trend and adopts a brand new one. These momentum shifts, that's where the most powerful, high-reward trading entries actually live. The goal here is not to predict the future or guess when a trend ends. No, it's to spot this character shift the exact second it happens so you can align with it.
There's this amazing analogy in the Masterclass that makes this super intuitive. Just picture a lazy student. Every single day, they sleep in until 9 a.m., they blow off their homework, and they just lounge around. That's their established trend, right? But then, suddenly, one day they wake up at 5 a.m., they go for a brisk walk, and they actually sit down to study. That small, sudden break in their daily routine completely shifts their life trajectory. Well, their character has fundamentally changed. The market behaves in the exact same way. So, tying that student analogy directly back to the charts, if a market has been constantly acting lazy, moving downwards by making lower highs and lower lows, and then suddenly, boom, it forms its very first higher low followed by a higher high, the character of the market has just changed. The routine is broken. That first structural shift is what the source material explicitly calls the wake-up call.
Moving right along to Section 3, fueling up with liquidity zones.
Okay, so a change in character is great, but it doesn't actually mean much without massive energy, the fuel, to sustain it. That's where liquidity zones come in. To find these, the Masterclass actually suggests zooming out to a larger time frame, like your 15-minute chart. You're looking to mark the specific levels where massive market moves or really sharp reversals originated in the past. Because this is where the real institutional money is just sitting and waiting to act.
It all comes down to the psychology of trapped traders. Down at these liquidity zones, traders are experiencing either absolute peak profit or devastating peak loss. And what does that do? It triggers emotional panic. When panic sets in, heavy volume is injected into the market as everyone scrambles to cover their positions. That massive injection of volume, that acts as the rocket fuel required to sustain our new change of character trend.
And here's a cool little bonus. Knowing where this fuel sits also solves another massive headache, knowing exactly where to take your profits. Once a change of character happens and gets fueled by one liquidity zone, price naturally just gravitates toward the next one. Therefore, your profit targets should logically be the next major liquidity zones you've already mapped out on that higher time frame chart. Makes sense, right?
All right, Section 4, the double confirmation rule. Okay, slow down here, because the Masterclass gives a massive warning. That first change of character you spot, it is just a wake-up call. It is absolutely, emphatically not an immediate entry signal. I repeat, not an entry signal. Jumping the gun on this very first sign of a character change is exactly how eager traders get faked out, totally trapped, and stopped out of their positions.
Why? Well, as the Masterclass points out, the market will often test traders by attempting to go back to its old trend. You have to have patience. The market actively tries to trap participants who are just way too eager to jump into a new trend. It wants you to commit early so it can take your liquidity.
So here is how that builds into the ultimate golden rule. The trap is entering on that very first change of character. The professional move, that's the double confirmation. You literally must wait for the market to pull back and try to resume its old trend. If that pullback fails to break the new structure and instead creates a second change of character in your anticipated direction, boom, you now have double confirmation. It's that failed retest that actually validates the new trend is real.
Only now, once that overall direction is definitively confirmed by price structure, do you start timing your exact entry. This is the moment you drop down to your smaller time frames. And honestly, here is the best part. This is exactly when your favorite indicators, your EMAs, SMAs, Bollinger Bands, finally become useful. They're incredibly powerful tools for timing, but only as a final step, after price action has given you the structural green light.
Let's wrap all this up with Section 5, your CoC execution checklist. To totally eliminate the guesswork, the Masterclass provides this strict 4-step execution plan to radically improve your risk-to-reward ratios. Here we go. Step 1. Mark your liquidity zones on the 15-minute time frame. Step 2. Spot the initial change of character. Remember, that's your wake-up call, but do not enter yet. Step 3. Wait patiently for the double confirmation, which is that failed retest of the old trend. And Step 4. Drop to a lower time frame to find your exact entry using your preferred technical indicators.
Which leaves us with the ultimate question you've got to ask yourself every single time you sit down at the charts. Are you still stubbornly trying to predict the market, or are you finally ready to patiently align with its character? Stop guessing what the market's going to do and start reacting to the structural facts it's actually giving you. That is how you stop getting trapped and start trading with true momentum. Thanks for hanging out with me on this explainer, and I'll catch you next time.